Okay, welcome everyone to this evening's ACY Securities webinar. My name is Duncan Cooper. So tonight's webinar is all about risk and trade management, and we'll have a good look at risk to reward. That'll really help you with trading if you can grasp the concept of that and put it to task. So we will get to that in a moment. All right, we'll move along. Now, for those that don't know me, my name is Duncan Cooper. I'm the Senior Market Strategist and Trading Mentor here at ACY Securities. And I'm a full-time Forex trader. I've been trading the Forex market now for more than 15, so actually nearly 20 years. Mentoring for more than 10. If you want to contact me, my email is there, duncan.cooper@acy.com. Through the week, you can connect with me at our website, acy.com. Go to the Market News tab. At ACY Securities Australia, if you want to connect with us on YouTube, and if you want to connect with me personally, my Linktree page is there, and you can connect with me there at that page. And charts that I'm using tonight, if you want to get access to those, then contact Nathan Bray's emails on screen. I'll put his details in the chat later for those in the webinar. But I'll be too happy to set you up with my charts if you want to use them in MT4. So let me close this presentation down and we'll get into tonight's. So tonight's presentation isn't all about the charts. We'll actually go into the platform a little bit later to show you how to utilize the trade size calculator. But tonight isn't about technical analysis. It's all about the topic of risk and trade management. Now, of course, if you don't know any technical analysis, then you'll probably not know what you're doing, and that will be risky as well. But tonight isn't about reading charts. It's about all the other things that are of risk to you when you're trading and getting you across those things so that you can incorporate with your daily plan. So we're going to cover these topics. We may only run about 30 minutes today. We'll go longer if there's lots of questions, but I'm just going to run through the presentation. We're going to go into platform, look at the trade size calculator. I'll show you how you can adjust it, answer any questions, and then wherever we're at that time, we'll wrap things up. So let's get into the first topic, which is money management. So money management is the most important topic that we will cover. And it's important that you understand that no trading strategy will win 100% of the time. Every trader will have losses from time to time. I've been trading nearly 20 years and nothing's more true than that. I have losses. So it's essential that you only trade with money that you can afford to lose. And we'll call this money your risk capital. Trading with money that you cannot afford to lose will create trading stress for you and impact your trading decisions, all right? Don't be trading with money that you need next week to pay the rent or the mortgage, or some bill that you've already, you have to pay with that money. Don't be trading with money that you need to cover your bills. So to minimize the impact of losses, you should follow strict money management rules. And I would suggest, this is what I do, your risk per trade should not exceed 2% of your risk capital, whatever that is. If you're new to trading or have a large amount of risk capital, consider reducing your risk per trade to 1% or even 0.5%. When you're new to trading, you may have more losses at the start if you're, finding your feet. So start with a small percentage risk until you get comfortable. Start showing results. Then, of course, you can increase your risk, but you don't want to be increasing your risk to 5 to 10% per trade. That's great when you're winning, but if you hit a losing streak, you won't be feeling too well about things. Okay, so 2% maximum if you've got a large amount of capital, 1% or 0.5%. So when opening a trade, you must always place a stop loss order to protect your risk capital. And after opening the trade, you should never cancel your stop loss order. So wherever you're putting it, is putting you're putting it there, and that's telling you that you're wrong when price gets to that stop loss. You just have to accept it and move to the next trade. So after opening the trade, you should never cancel your stop loss order or move your stop loss order further away from your initial stop loss level to avoid a loss, because that may work for you a few times. Price may turn around and you end up with a winning trade where you would have had a losing trade. But at some point, you'll be on the wrong side of the trend. You move your stop, price keeps moving down, or below the level of your stop or above the level of your stop, depending on the direction you're trading, and your losses just keep getting bigger. And eventually you'll blow your account. So you just have to accept that you're not going to be right every time. That stop loss level that you're putting in is where you're telling yourself and the market that you're wrong and you're getting out. So you're going to have a very short trading career if you do not adhere to these rules, okay? If you do not use stops, or you put a stop in, then move it or cancel it, sooner or later, the market will catch you. So as a general rule, only have 1 or 2 trades open at the same time. Having multiple trades open only increases the potential risk to your trading capital. Do not trade 2 correlated pairs at the same time. If you buy euro dollar and Aussie dollar at the same time, both trades can potentially lose if the US dollar appreciates in value. Now, I may trade 2 correlated pairs at the same time, but what I will do is, if I trade the euro dollar, I might trade that first. If I can get that trade to break even, so I have no risk on the trade, I may elect to trade another pair to the US dollar. But I won't have 2 trades at risk that are correlated. As well, if you buy Aussie yen and Aussie dollar at the same time, both trades can potentially lose if the Aussie depreciates in value because they both contain the Aussie. All right. But the same rule would apply for me there. If I've traded Aussie yen, let's say I bought it, that trade's now risk-free, and I see a setup on the Aussie dollar to trade to the upside, well, I could take that trade because I only have 1 trade at risk. Yes, they are correlated, and yes, if the market turns around and goes the wrong way, I'll get stopped out at break even on one and I'll lose on the other, but I can only lose on one if I have 1 trade at break even from my stop loss perspective. And as well, if you trade euro yen and pound yen at the same time, both trades can potentially lose if the Japanese appreciates in value. So understand what pairs are correlated. Usually any pair that's got the same, any 2 pairs with the same currency in it are potentially correlated. All right. Now in my trading platform, I'll show you how you can put the trade size calculator on it. I'll show you in the bottom left corner here. And I will show you how you can alter it. So we'll get into the platform a little bit later. But as you can see here, in the way it's set up initially, it's for intraday trading. So it's tell you 2% risk on your account. That's the dollar amount. And then if you wanted to use a 15 pips stop loss, the trade size, lot size that you can trade is 1.02. 20 pips, 0.76. 25 pips, 0.61. Okay. So the trade size calculator will show you what your 2% risk per trade is based on your account balance. Yes, you can alter it to adjust the risk percentage. I'll show you how you do that. But initially, this is how it's set up. 2% risk and the correct trade size that you can trade for a 15, 20, or 25 pip stop loss so that you can only risk 2% per trade. And it works that out on your current balance in your account. The settings of the trade size calculator can be adjusted, as I've said, to suit your needs. So we'll go to the platform and show you how you do that. But please note the trade size calculator only works correctly on the currency pairs in the platform, okay? Anything else, it probably doesn't calculate properly. So if you're going to use it on things like stock indices, oil and gold, it may not work correctly, so please be aware of this. So I have a disclaimer. She's just saying, you're responsible for the use of the calculator if you want to use it. If it doesn't calculate correctly, it doesn't calculate correctly. To my knowledge, because I use it, it calculates perfectly correct on the currency pairs, but not necessarily on stock indices, oil and gold, and other instruments. All right. So you have to make sure that you're quite happy with what the calculator is calculating for you, and we won't be held responsible if it's not calculating the right trade size for you. You use it at your own risk. So let's talk about risk reward. This is my number one trading tool, okay? I have wins, I have losses. I never make out that I never have losses. So, if you're having wins and losses and you have like a 50-50 hit rate, as long as you've got a good risk to reward over a period of time, you should be able to start to be looking profitable on your account. So risk to reward is the number one trading tool. You can have more losses than wins and still be ahead if you employ a good risk to reward model. When it's setting up your profit targets, you must use a risk reward of at least 1 to 2. I've discussed this before in the trade setups that I went through. So you must have a minimum of 1 to 2. I will often have 1 to 3, 1 to 4. I'm in one at the moment. I think that's 1 to 6. I'll show you on the Aussie dollar if we have time, just on risk reward. But as a rule, make sure it's 1 to 2 at least. So if you're risking 20 pips, let's say on a trade, target 40 pips to give yourself a risk reward of 1 to 2. If you're just shooting 1 to 1, so risking 20 to make 20, you won't make money. Unless you have an exceptionally high hit rate, which most people don't. So why is 1 to 2 risk reward so important? If you have a 50-50 win-to-loss ratio and you use a 1 to 2 risk reward, you have a good chance of achieving consistent results over a period of time and being on the positive side of the ledger, okay? You cannot be profitable using 1-to-1 risk reward if your win-to-loss ratio is just 50-50 because you win one. Let's say we're risking $10, we make $10. So when we win, we make 10. When we lose 10. If your hit rate's 50-50, you're just winning 10, losing 10, winning 10, losing 10. You're not making any money. And if you're slightly having more losses than wins, you're down. So you need that risk reward to get positive. So, my own win-to-loss ratio is slightly better than 50-50. Sometimes can be 25-75. But I'll have good periods in the market. I'll have poorer periods in the market. In my poorer periods in the market, I'll be 50-50. Okay. So I'm always employing a 1 to 2 risk reward or greater when I take a trade. And where possible, I let my trades run and allow them to meet my profit targets because I need to achieve risk reward on my trades. Doesn't matter if I'm getting stopped out at break even on some trades, but I can't be just taking short-term profits because when I have a loss, that short-term profit is just completely eroded. So I have to be prepared to try to give my trades the opportunity to meet their targets. And this whole concept is the main reason why I'm able to achieve consistent results from one year to next. It's not because I'm an excellent trader. The market's always right. I just try to be on the side of the trend more often than not. And if the market's continuing that trend, I will generally then have the opportunity to be right. It's not me that's being right. I'm just following the trend or try to follow the trend a lot of the time. And as long as the market isn't going to change trend, I will be in the correct direction of the market and have the opportunity to make some money. Now, I can be taking trades with the trend and then the trend changes. And sometimes the market can do that quite a number of times and get very frustrating. But that's trading. You just have to obviously live with what the market can do, but you have to have good risk reward. And the more experience you get, the higher risk reward trades you may be able to potentially create for yourself. So the profitability of trades will be improved by following effective trade management rules. And there's not a perfect set of rules that will suit all markets. So I'm going to give you a set of rules. There'll be a good starting point, and then you can adapt them for yourself. All right, so you can adapt them as you develop your own personal trading style, because we'll all trade differently. If I give everybody the same rules, you'll all trade differently. You might be using some of the rules, but everybody will be trading ever so slightly differently. So first rule, reduce the risk from your trade when price moves towards your profit target. This will help you preserve your trading capital. So move your stop loss to your trade entry level when the trade is halfway to your profit target. So for example, if you're targeting 40 pips, move your stop loss to your trade entry level when your trade is up 20 pips. I've got no problem about getting stopped out at break even and then moving on to the next trade. All right. When I'm up, what I'm risking, get the risk out, because what happens if then price just turns around and hits and wants to go back to your entry level, and more importantly, back to where your stop loss is sitting. So when you're up what you're risking, get the risk out. Move your stop to your entry level. Moving your stop loss too soon will generally result in break-even trade. So don't get too nervous. Just wait for the price to move up or move down to profit. So once you're up what you're risking, simply move your stop loss to break-even position. Now, there can be times where I will move my stop loss quicker because I may see something that I don't like on the chart. And, I could be up 10 pips. And maybe there's a level of support or resistance that doesn't seem to want to break, or a pivot point or something. And I might go, okay, well, you know what, I'm going to go to break even. This is either going to move my way now or it's not. So there will be times where I may move sooner. All right. If I see something definite that I don't like. As I just said, approaching pivot point, support resistance level, and you can see that price may not move beyond. Then, ending with a break-even trade is way better than a losing trade. All right, so at these times, move your stop loss to your trade entry level. But of course, don't get too antsy and too worried about things all the time, or you'll never let your trades run to the target. You'll just keep getting stopped out. All right, so break-even trade is far better than a losing trade, but as I said, you just can't be going break-even all the time because you're getting too scared and nervous in the market. But if there's a legitimate reason to maybe move your stop quicker, then do so. All right, so there's no guarantee that your profit target will be met even though you've set it. So continue to move your stop loss as your trade becomes more profitable. So if you're targeting 40 pips and you're up 30 pips, I generally then will lock in 20. When I'm at 35, I'll lock in 30. And then price is either going to hit my target or come back and stop me out for a 30 pip profit. All right. And if you're intraday trading, you should not hold trades open over the weekend because price can open up at a different price point. So ensure that you close all your trades and cancel any pending orders before the market closes. So if you're just trading with tight stops, close your trades down prior to the weekend coming around, because there can be large differences between a currency pair's closing price and ending on Friday and its opening price on Sunday. Sometimes the market can gap down 100, 150 pips up or down from where it closed. And if you were just using a 20 pip stop, market will gap over your stops and you'll get filled where the market opens, not where your stop is. Steve, you're asking me, would I consider closing trade early instead of moving stock quicker if you're concerned price will advance? Well, if I really think it's not going to advance, I can just close it. However, if I'm just concerned that a level may not break and then turn around, but I want to, I don't know when price say trades up to a level of resistance that I'm hoping will break. I don't know it's going to break or not, but I might want to give the market the opportunity to try to break it. So if I want to give the market the opportunity to try to break it, I can just get my stop to break even quick. Will the market break it or not? Of course, if it doesn't break it, I could get stopped out for zero. Whereas if I just jump out, I'll make like some profit. But I tend to try to keep in the trade and give the market the opportunity to run and break levels. And if I want to be in a trade that can move 300 to 400 pips, I can't worry too much about every support and resistance level that the market's going to contend with. So I tend to try to give the market every opportunity to break levels when I'm in a trade. But of course, I don't want to see a failure at a level and then lose money. So I'm a lot more happy to give the market the chance to make me profit, and worst scenario, have a break-even trade. All right, so price gaps can often occur against you, and it is a risk that should be avoided. Of course, price gaps can go for you, but this whole topic is about managing the risk. So if you're trading with very tight stops, I will close my intraday trades down before the weekend, have them finished. And the release of major news announcements can dramatically impact the profit of your trades. And ahead of a major news announcement, you should ensure that your stop loss has been moved to your trade entry level, or that you close your trade. If a news announcement is going to be coming out and it can move very quickly, 50 pips, and you're very close to the market with your stop, you're better off being out of the market, because your stop will probably price will probably gap over your stop and you won't get filled at your stop if a major news announcement is coming out. So each country releases important economic news announcements, and following the release of an announcement, price action can be very volatile. It is important to know when an announcement will occur so that you can manage your trades effectively. So I use forexfactory.com, but a detailed list of the important economic news announcements for the trading week can be found at those two websites, forexfactory.com or finlogics.com. I think most traders tend to use Forex Factory. That's the one I use. We'll go there and I'll show you how to set it up. And you're going to need to pay attention to the red calendar events. We might go there now while we're talking about it. I use this in my analysis webinars, but forexfactory.com, there's the website. At the website, main website, this is the page. I tend to have a week's view. So I go into clicking on that, and you can go this week, apply, and then it will show you the whole week here. And I just focus on the red calendar events. I will take a note of the brown ones as well, but you can come into up here to the filter. I don't like the yellow ones because there's lots of them and they're not very high impact at all. So I just have the red and the brown selected, and then you apply the filter. As well, if you click on this time thing here, you can set it to your zone, save, and then the calendar will be showing your time zone rather than somewhere else. All right. So what I will do is, start of the week, I'll look at what's coming out. And I like to know what's coming out for the week, and then of course be at least in front of what's happening today and tomorrow. All right. And sometimes I will look forward to the next week. I can see next week we've got US CPI data coming out Wednesday, and probably Thursday, Friday in here. Friday we have, so we've got core CPI, we usually have, so into next week, well, we usually have core CPI and then PPI in the same week, but CPIs in next week and the week after we have PPI. All right. So good to know where all the major events are coming out. I like to be at least a week ahead, sometimes 2 weeks ahead, just knowing where the big ones are coming out for the month. All right, so that's forexfactory.com. And headline news affecting the market can be found at cnbc.com. I'll just look at that and see what headlines are there and does anything give me any indication where price may be moving today. Often it doesn't, but I just look at the headlines, okay? Especially after the FOMC, I'll go there and look at see what got said at the FOMC statement and what's getting reported, and am I reading anything that makes sense to me that I might want to utilize in my trading. All right, so news announcements. The extremely high impacting news announcements for a country are interest rates, job figures, GDP, CPI, trade balance, retail sales, and central bank speeches. Those things from a country can affect a currency movement. Pay particular attention to the US news announcements as they have the potential to impact the price movement across all currency pairs. All right. And we obviously live in a global economy and world news travels fast via social media these days. And you have to manage your trades effectively at all times. When the market is waiting for high impact news release, the best thing to do is to not trade. Unless you're in a long-term positional trade and you're in profit. But if you're just intraday trading and we're waiting for a major news announcement to come out, best thing to do is wait for that to pass and then trade afterwards. Being in a trade, hoping that it's going to go your way is just a recipe for disaster in general terms. Because price can go either way on a major news announcement. We've got the US job figures on Friday. So if you've got an intraday trade open just ahead of then, it can whipsaw both ways. It can go strongly one way or the other. And if you're not in the right way, you will get a rather large loss. Now, holidays, of course, we've just come out of a holiday season. So national holidays will affect the markets. When nations respect holidays, such as Easter and Christmas, the market will slow down. We've seen that through the Christmas period and become range bound. Traders are taking holidays and trading volume significantly reduces through those periods. Major holidays can be found at forexfactory.com, where I just showed you. It will list on that page when they're coming up, and same at vinlogics.com. All right, so those are really all the major things that I would say to a new trader or intermediate trader to look out for in terms of risk and managing risk and navigating the market from a risk perspective. Let's just go and have a look at the trade size calculator in the MT4 platform. And I just want to see what's happening on some pairs while we're in here. All right. So let's just go to the euro dollar. Now, if you get my MT4 charts, this is how they look. I'm in the 12 pairs at the moment. 50-minute chart. Now you can get it so that the trade size calculator will appear here. I'm in a demo account at the moment, but if you come up to this button, navigator, I just have to refresh my memory. Yep, that's fine. So come to the navigator button up here, click on it. This will open up this window to the side. We want to put on, if you want to use the trade size calculator, they're not on the charts as a preset. The trade size calculator is down here. You'll have it if you've got my chart set up. Left click, hold, drag it onto the chart, like so. I'll just move that into the middle. And then Visualization, I tend to have it just on 15 and 5. Inputs. At the moment, it's preset at 15 pips, 20 pips, 25 pips, a risk of 2%. So if I click OK at the moment, you're going to see it comes in on the chart here. Now, my account balance in this demo account is 4977,082. So what the calculator is doing is calculating 2% of that trade balance. And that trade balance is in US dollars. All right. Now, can't really see it there. Sometimes candles and stuff get in the way. What you can do, if you don't want it on the 15-minute chart, you can put it on a different chart if you want. So for example, we could go right click on the chart, go into indicator list, find the trade size calculator, double click on it. Visualization, I could just put it on my daily chart. Click OK. And then go to my daily. And you know, over here, there's no candles at the moment. So that's great. I can just see that panel. And if I wanted to trade, I could, of course, you know, I'm going to use a 20 pip stop. I want to risk 2% on my account. I know I can trade a lot size of 4.98. All right. Now, if I want to adjust any of the items in here, right click, indicator list, click on it. Trade size calculator, double click, go to the inputs page. If I wanted to put in, for example, I often talk about 100 pip stop loss. Double click into that field. If I want to know what 100 pip stop loss would be, and maybe I only want to risk 1% on my account, 1.0. Okay. Okay. So now it's telling me over here 1% risk per trade is 498. For a 15 pip stop, I can trade that size. 20 pips that size. For a 100 pip stop, I can trade 0.50. So 0.50 up here would be 0.50. That would be the trade size if I wanted to set up a 100 pip stop, and I would risk 1%. Now, as I said before, trade size calculator only works on the currency pairs. All right, so be aware of that. You can try it on other things, but double check that it's calculating properly. I don't check that that's calculating properly because I know it's calculating properly on a currency pair. I've used it many times. So I just look at that and go, okay, there's the trade size that I want. But then I put it in my order, depending on how many pips I'm risking and how much percentage risk I want to risk. Okay. Any questions on that? So if you have your chart set up with Nathan and get my chart layouts, trade size calculator isn't attached to the charts. You'll have to find it down here at the bottom and then drag it onto the chart. Now, you don't need it on every chart. So for example, if you're trading pairs to the US dollar, you only need this on one pair to the US dollar. It's the same calculation for every pair to the US dollar. If you're trading a yen pair, it's the same calculation for every yen pair. So you only need it on one yen pair. All right. All right, so what I wanted to do is to finish up in terms of risk reward and to show you how I sometimes, you know, get a better risk reward in 1 to 2. I was yesterday discussing the Aussie dollar and a trade that I'm in. And I was talking about the monthly chart that we got very close to monthly support down here. And I was generally discussing the idea that maybe we're in this long-term range to the weekly, just so you can see it. Is I did trade down here at 6,200. And what I'm doing is I'm targeting up here at 68.97 across there. So I'm actually targeting up there at 69, risking 100 pips. So entered at 62, targeting 69, that's 700 pips and risking 100. So that's a risk reward of 1 to 7. All right. That's how I can create, even though I'm risking 100 pips, that's how I can create using the major time frames and looking at major support and resistance. That's how I can create the potential of a good risk to reward trade. Now, I don't know if that trade is going to work, and I'm not suggesting to everybody that you just go and trade it right now. I'm just showing an example of a trade that I've taken recently. I don't know if I'm going to be right on it yet. I could be wrong on it, but that's how I, when I can see a clear range and one that I did take, which I didn't maximize my profit on. I had a similar trade last year where I traded at the top of this range, and I was looking to trade to the bottom of the range, which was, I think it was down there at the time I was targeting. And I ended up getting out because of the election in the US, but this range was about at least 500 pips, and I sold it up here with a 100 pip stop. I think I made about a risk reward of 1 to 4 eventually. I didn't quite make it down to the target because of the election, but there's another example of how I was creating, say, a risk reward there, 1 to 5. All right, so you can create good risk reward from the high time frame charts, but it's a matter of defining clear support and resistance. Are we in a trend? Are we in a range? What is the market doing? All right, so that's all I wanted to go through tonight. Tonight was all about risk, not really the charts, even though I've just gone through a couple of charts there. A bit more of the boring stuff to trading. Of course, we all want to jump on the charts and just take a trade, but we really need to think about what's creating the, every time we take a trade, there's risk involved. So what are all the things that can create risk for me in the trading world? How can I alleviate the risk or the risks where I can? It's going to help you be profitable, okay? So I'll leave it at that. What I will do is I will put it in the chat right now, Nathan's contact details and tonight's link for tonight's presentation. I'll just give you a moment to hit the link so you can download the presentation. Any questions, just shout out before we wrap things up. So why are you just grabbing that link? If you want to join me for another webinar this month, at the webinar page, there's the link at the top. I will be back with you next week, next Tuesday, the 14th, where I'll be doing more live analysis, okay? And then the 15th, I'll be taking you through the topic of position trading using the monthly and weekly trading ranges. Getting into the advanced section of the webinar series. So that will be the topic on next Wednesday. All right, we'll wrap things up there. Thanks, everybody. Hopefully you got some value from that. And if you want to join me next week, there's a webinar link at the top. I'll look forward to seeing you next week if you have the time. Just come to the page and register your interest. Other than that, have a great trading week. Happy New Year to you if it's the first time you're back with me. And I look forward to seeing you again through the year. Thanks, everybody.